Yeah, so I mentioned in a previous show that when I wake up in the morning, I often open up certain things on my phone to keep abreast of my personal finances. So it might be a budgeting app, for example, and I might look at the app and the statements on my account. Just to give a quick overview, I'm just looking, spinning the plates, making sure things are ticking along as they should be. And the other thing I do is I open up the stock market app on my phone. Now, I'm not obsessed about looking at my own investment portfolio. In fact, I never look at my own investment portfolio, the value of that on a given day. I tend to review that maybe once a month, just have a look what's going on with it, but nothing really more than that. And I then might make a decision subsequently with 80/20 Investor. Obviously, I run a portfolio that started off with £50,000 in it that I have grown over time. Actually, it's got a profit of about 50%. So I have been doing that for 8 years now. And of course, people who are subscribers to 80/20 Investor know that I then review my portfolio, might make some changes. But on a day-to-day basis, I like to get a feel for what's going on in investment markets. And you can do that very quickly because if you set up your stock market app on your phone, now whatever phone you use, there will be a default app, but you can find others. So there is an app called investing.com. So investing.com is a website. They have an app which is very good actually. It's free. You can download it and then you can put various different indices on there. For example, the FTSE 100. That's one just off the top of my head that you could put in there and then you can see how it's moving live. And what I find useful is to set this up with certain exchanges on there, certain stock markets, and by looking at it, I can get a feel for what's going on, potentially what's driving markets right now at that point. And then I can think there's something's happened and I can guess probably what it is, and I can go and look at the news headlines and find out what it is that's driving markets. And it's particularly relevant if you see some really big market swings. So we're not obsessing about what's going on with markets. What we're doing is learning what's driving markets and understanding them, and therefore you can understand what's driving your portfolio. And even if you're a passive investor, I believe this is a good exercise because what it means is you tend to stay the course. You don't become emotional. You start to understand what is going on, that the movements you see are a natural cycle. They are responding to news flow. Some of it will be very knee-jerk and it might move back the other way the next day. So what I'm going to do on this piece is go through what I look at very quickly. Now, the podcast episode 184 was recorded 5 years ago and we do make our content evergreen on this show. So go back and listen to that particular episode because that was the first episode where I covered the markets that I have in my app. And I'm going to run through some of those again and tell you what they are. But if you go back and listen, it's well worth it because you'll get an explanation as to why they're in there. But also you'll get a reference point to a point in time, which was 5 years ago, why some of those markets or how I was looking at them, how they were interacting and what it told me. And I'll give you just one example. Back then, we were all obsessed with the US-China trade war. It's less of an issue at the moment. So markets were moving and I could look at certain indices and see that I bet there's been a new headline that's come out. And at that point, it was from Donald Trump, who was the president of the United States. Probably had a sound bite that caused a bit of market movement. Now I'm updating this list, giving you a few more, but they will tell us about some of the big macro stories that are going on in the background. So I'm going to get my phone out. If you're watching this on YouTube, you'll probably see me looking at my phone. I hope this is not going to impact the recording in any way. So the first one I look at is the US dollar index. If you go on your app, it will usually have a ticker of DXY or maybe have T.NB after it. But you can search for the dollar index, and that is a measure of the strength of the US dollar against a basket of currencies out there, including the pound and the euro. Now, I didn't used to track this 5 years ago, but if you get the dollar right, then you tend to get most other things in investment markets. So if you get the direction of where it's going to go and you somehow front run that, or you happen to be riding that wave up or down, then it has such an impact on other markets, then you'll probably get the other things right along the same time. So to give you an example of that, when the dollar index rises, that means the dollar's strengthening. That tends to be bad for things like commodities. And sometimes the dollar can go up and down because of headlines that are occurring out there that might be in relation to other central banks. At the moment, the biggest thing that is driving markets is about inflation in domestic economies and what central banks are doing. We've seen the US Federal Reserve seemingly more dovish than some of the other major central banks, particularly the Bank of England. And of course, what happens when market expectations change, then that can influence the currency exchange rate. So if the US Federal Reserve is expected to perhaps pause its rate hikes versus the more continued rate hike cycle that we're seeing in the UK, then the dollar will weaken against the pound, and of course the dollar will likely weaken against the euro as well, because at the moment the European Central Bank looks to be still in its rate hiking cycle, and what that will mean is the US dollar index will fall, and of course that will have implications for other markets, like I said, commodities. It will likely mean that emerging markets will do well. It will likely mean that the S&P 500, that the US stock market will do well. When the dollar weakens, it tends to be a tailwind. So I look at that. I look at what's going on with the dollar index, because if that was suddenly up as well, it can be a sign of panic, because people do tend to move into the dollar as a haven asset. I mean, often the yen works in the same way like that, but historically, the dollar has been a haven asset. So I look at the US dollar index. I like to see if there's any big moves, that means something's happened. At the moment, it's probably something to do with central bank policy or inflation somewhere, or it could be there's been something a bit bigger than that. Perhaps there's been some geopolitical concerns. I then still have the US dollar and pound exchange rate. You can search for that. It's GBP USD equals X. That's what it's typically on the stock market apps. I have the pound euro exchange rate, and I also have the pound yen exchange rate. So again, the dynamic between each of those currencies will tell you a lot at the moment, probably about the outlook for the central bank monetary policy in those particular economies. So if the pound strengthens against all of those or any of those currencies, then it probably means that the market is viewing that the Bank of England is going to be more hawkish, meaning probably more rate hikes. Or it could be that one particular bank out there, central bank I'm talking about, maybe it's the ECB, is being more dovish, talking about potentially pausing, then you might just see that pound euro exchange rate change and the others stay constant. If that was to occur, you would see one move and one not. You know that there's something probably going on in the news relating to that particular central bank. I still have the VIX, so VIX, that's like the market fear gauge. Historically, that number's around sort of 1921, but at the moment we're below that. So I look at that. If there's a big spike in the VIX, that means the fear's gone up in the US stock market. The VIX is a volatility measure, but effectively just think of it as a fear number. So if that goes up very quickly, that means the market's got spooked. I now also look at the NASDAQ 100 VIX. It's got a tracker ticker number of VXN. So find that one. That's the same thing as the VIX, which is relating to the S&P 500. This is relating to the fear on the NASDAQ 100, which is much more tech focused. I'm still looking at the 10-year US Treasury yield. That has a ticker of TNX. Now, a couple of years ago, well, back when I did this last, I said a couple of years ago, 5 years ago, the yield on the 10-year was 2.8. We're now obviously much higher. We broke above 4 recently. When that yield goes up, that means that the value of the Treasury is going down, so the 10-year US Treasury. In recent history, that has been going up because of inflation concerns. So when I open my app in the morning, I look at the yields on that particular issue of US Treasury, but I also look at the 10-year UK gilt yield. So the stock app on the iPhone doesn't have that as a standard because Yahoo doesn't really have that ticker, but you can find it on investing.com's app. So get the 10-year UK gilt yield on there. I mean, as a UK consumer, it also shows you that yields are going up. If you follow that and it's going up, then in time, it will probably start to have an impact on mortgages as well. So I do like to track the yields on those because they also give you a feel for bond markets more widely. So if yields are going up, then that's going to be bad news for bonds. But it also probably means that there's been something going on in the news that is suggesting that maybe inflation is going up, or that the UK economy, or whichever economy, it could be the US if we're looking at the US Treasury yield. It could be that if the yield is going up, there's been news about how robust that particular economy is. Or if the yield suddenly tumbles, it could be because there's fear out there of a recession. So you might see there's some headlines out there. Maybe a central bank has talked about recession. I still track the FTSE 100, the FTSE All Share, and the FTSE 250. Now, the FTSE 250 is very domestic orientated versus the FTSE 100, which obviously around about 80% of the constituents of the FTSE 100. Those companies get most of their earnings from overseas, particularly denominated in US dollars. So what you tend to see is that if the pound strengthens against the dollar, going back to that earlier exchange rate that I track, then it tends to be bad news for the FTSE 100. So sometimes you'd like to see that when that goes up, that's the pound versus the dollar, then maybe the FTSE 100 will go down. If that doesn't happen, you start to ask why. It would be slightly unusual. So you might look at other things that are going on out there. You might start to wonder what news is driving that sort of divergence from historical norms. But of course, if the pound falls against the dollar, then the FTSE 100 will of course go up. Not guaranteed, often does. I like the FTSE 250 because it will, if there's been a rally in that means there's been some good news probably about the UK economy. Of course, I'm still tracking the S&P 500, the Dow Jones and the NASDAQ in America. Now, those three, they are obviously key to a lot of markets out there. What goes on in America tends to influence a lot of other markets, and because of the time difference, in the morning when I wake up and I look, I will see how markets finished in the US, and it'll probably give you an indication of what could happen in the UK and in Europe once the markets open. And of course we have Asian markets, which I'll come on to shortly, that I look at as well. But I'm really interested in the difference between the S&P 500, the Dow Jones and the NASDAQ, because they don't all move up in tandem. It's when you get a divergence that I'm interested. The S&P 500 is influenced heavily by those big tech names, and they have driven most of the rally in this year. But when you see the Dow Jones maybe go down or the NASDAQ go up, when the Dow Jones goes down, then it's that interaction that I'm intrigued at. So often you might see the S&P 500 has gone up. All three of them actually you often see go up, but you might occasionally, I should say, see the S&P 500 go up, the Dow Jones go down and the NASDAQ go up, or the reverse pattern. That tends to tell you there's something that is going on underneath. So it's to do with particular sectors, because the Dow Jones again is more economically focused, because it's a smaller index with fewer companies in it and most of them aren't tech orientated. It will mean often, if you look at it, it could be something to do with the banking sector, something like that. The German DAX I'm still tracking, so that ticker is GDAXI, and of course the Euro Stoxx 50. Now, the DAX, the reason that I like the DAX is because it gives you an indication of European stocks, but it also normally has a high correlation with the S&P 500. So if it's not moving in the same way as the S&P 500, so they kind of move in opposite direction, that probably gives you a hint there's a European story in there. And of course, a lot of this 5 years ago would have been related to the fallout of Brexit. We don't have that as much now. But what you might see now, when I see the DAX do something, and it might be, let's say it was negative, or it might have been very positive, I then go and look at another index that I track, which is the CSI 100 index, which is a tracker of the Chinese stock market. I look to see if that's up big, if the German DAX has gone up, because it could be a growth story, a Chinese economic growth story. So at the moment, we're getting concerns about the strength of the Chinese economic recovery since the pandemic. If we get a headline that's negative around that, look at the Shanghai Composite in the morning. If that's down significantly, and then look if the DAX is down too, then that has a high exposure to the Chinese economy because of the export. Germany is a big exporter to China, so the German DAX will be impacted more so than maybe some other European stock markets. So I'll look at the Euro Stoxx 50 for a general European outlook or what's going on with European stocks, but I then look at the German DAX, and if something is happening in that index, I'm thinking perhaps there's something going on in China, and I look for that particular headline. Moving on, I'm not going to go through all of them because I'll be here all day, but some others I look at is the price of gold, so that ticker is GC equals F. I look at copper, HG equals F, and I look at crude oil, which is CL equals F. The reason I like those is because gold can give you a hint. If there's panic, then the gold price might go up. If there's not fear, then it might go down. But also gold will move significantly when there's rate hike expectation changes. So let's say, for example, the market suddenly thinks that inflation was stickier in the US than previously thought, and that the Fed would have to hike rates, what you'll probably see is gold will fall, because gold tends to do poorly in an environment where rates are going up. I like to look at copper and oil because they're commodities. So if they are up big when I look at them in the morning, then again, if I look at what's going on with the Chinese stock market, it probably means if that's up as well, there's been a headline about economic growth in China. Some data's been released. I also look at Asian indices, the Nikkei 225, which is the Japanese stock market as well, because again, that's still a significant stock market, but I don't dwell on it too much. The other things I like to look at is sector-based stuff in the US. So I look at the utility sector, which is XLU, technology sector, XLK, financial sector, which is XLF, and I also look at the healthcare sector, which is XLV. These are all the tickers you put in. They're actually ETFs that follow these particular sectors. And there is an energy one, which is XLE. Now, I like to look at all of those because if they move in different directions, which they do tend to, you do get days, of course, where they all are up or they're all down because the market is generally being either risk on or risk off. Then that in itself is quite interesting, because if they're all up, then you know that the market was in a state of euphoria about something, and it's something that's generally very positive, so they'd all be up. But if it's something just generally negative, they'll all be down. But if there's a differential between them, let's say, for example, utilities and healthcare are up, but some of the other sectors are down, then that could tell you that they're more defensive sectors. It could tell you there's something going on, that maybe there is a concern about recession. If the financial sector's up big and the others aren't, normally if the financial sector's up big and the technology sector's down, then I look at that and go, there's been a story again about rate rises, because when rates go up, so interest rates go up, the finance sector tends to do better. We talked about this, I think, recently on the podcast, about that when rates go up, banks make greater profits. That's the general rule of thumb. But technology stocks tend to underperform, because when rates are going up, because their earnings and a lot of their profits might be way off in the future, when you discount that back with a higher interest rate, it will mean that that number is smaller. So just think of share prices as being a discounted number, a discounted value of future earnings. Therefore, if that interest rate is higher, it means that the share price tends to be lower. You don't need to really understand that, but just believe me, technology stocks tend to do very well when expectations of rates going up are occurring. And a part of that is also maybe because it could be that some of these smaller technology companies, not the massive ones, but some of the smaller ones might have high levels of debt which they have to service. So there are others I look at in terms of individual stocks. I do look at Amazon, I do look at Apple, I do look at Microsoft. Now, and the other one I talked about in the last show was Boeing. So Boeing can be a good economic indicator, because obviously if the economy is doing well, then Boeing tends to do well. They'll be manufacturing planes. I think Apple is one that's just a broader indicator for the market. I mentioned it on the last podcast. I say the last one, I'm talking about the episode 5 years ago. As goes Apple, so goes the market, is the adage. Now, that tends to, it doesn't always hold true, but if Apple's going up big, it tends to mean the market does, or vice versa. So I tend to look at those to get an indication, is there anything going on at a company level? And I do like looking at Microsoft at the moment, because that is a big tech play. So I look at that particular one, because when I say tech play, I'm really talking about AI, because AI is one of the things that's been driving markets, and there's a bit of euphoria about AI, artificial intelligence, at the moment. So I look at that particular stock price, and I think that gives you a good sense of if any moves are being driven by AI enthusiasm. And Nvidia is another one. So there's just a bunch of, I haven't covered everything, but I've covered a hell of a lot. But what I want to do before we move on to the next part of the podcast, Andy, I'm looking at my phone, and like I say, if you watch this on YouTube, you can see I'm doing this live. And what I'm looking at is a live look at the market right now. So what I'm going to tell you is that as I'm looking at this, and I'm not going to tell you what the news story is until the end. So the dollar index is up. We've just got towards that 100 number, which is quite key. But the pound versus the dollar is down 1.2%. It was above $1.30 yesterday. It's now down to 1.288. It's a big move. Yet it's also down significantly against the euro and the Japanese yen. So it wasn't just one currency that it's fallen against. It wasn't just the dollar. The pound seems to have fallen against all currencies. So I'm looking at that now going, right, there seems to be a story out there that's relating to the UK because it's weakened the currency against, or the pound against, a number of currencies. So it's not just one-on-one. It's not just something to do between, say, the UK and Europe. So what I'll then do is I'm going to look down at the bond yields. They're next on my list. The US 10-year Treasury is pretty flat, not doing anything. But when I look at the 10-year UK gilt yield, that's down by 2%. So in terms of basis points, it's actually down about 7 to 8. That's quite a big move. We've just been seeing the UK gilt yield going higher and higher of late. I now look at the FTSE 100 and I'm like, hold on a second, that is up 1.9%. So as I mentioned earlier, the pound is weaker against the dollar significantly. You'd expect a boost to the FTSE 100. We got that. But look at the FTSE 250. You can't see this, but I'm just telling you, it's up 3.6% so far today. That is mental. That is a huge number. So my sort of spidey senses are going off. That is a big number for the FTSE 250, for any index. There is something that's been announced, or headline, that's going to have a big impact on the UK domestic economy because of the size of that growth, that rally versus the FTSE 100. So I'm looking at that and thinking, well, it looks like it's going to be a UK-based story. I look at what the S&P 500 are doing and the NASDAQ. They're all basically up about the same amount, about 0.2%, nothing much. I look at the German DAX, it's actually up 0.02%. It's basically flat. And the Euro Stoxx 500 is down ever so slightly. I look at the Chinese stock market, it's down 0.4%, nothing really exciting going on there. And I look at gold, it's down about 0.3%. And so what I can see from this when I'm looking, there is a UK-centric story clearly. And the giveaways are the pound has fallen significantly against the dollar and against other currencies. The yield on the 10-year gilt has fallen considerably, and we've had a rocket go under the FTSE 250. So straight away, without me even having to look at the news, I know that the good chance of what's come out is either the Bank of England has done something like said it's going to pause rate hikes, or, I mean, it's not going to cut them at the moment, but it could be a possibility in the future, or inflation expectations have dropped. And lo and behold, if you go and look at the news story today, what was the biggest story this week? It's the fact that UK inflation came in under expectations. So it was lower than people expected. And that's lit a rocket under all of those. Well, it's impacted all of those markets in that way. And it's particularly the UK. So you can see by looking at these, I was already able to see what's going on here. Whereas if I just looked at my portfolio day to day, or I'd be sitting there thinking that something was happening that was particular to my portfolio or the funds that I'm in. But what it really does by doing this is just to get you a feel about how assets behave with each other, what markets do, how you can build portfolios, diversification. It teaches all of these things, and it goes back to a point I raised in that original podcast when I did this the first time round, is that this sparks an interest, because when you see something move, you should, and you can't explain it, you should think, why is that not doing what I thought it would do? Or like I said about the pound falling against the dollar, I then looked at the FTSE and expect it to be up big, and it was. So that's like, yeah, I'm understanding that dynamic there. And the FTSE 250, that's up big. That should say something about the UK domestic economy. Yields are down on the 10-year UK gilt yield. Well, why is that? Yeah, it could be a sign of that potentially people thought there could be a demand for gilts because we could be heading towards a recession maybe, but that doesn't make sense because the FTSE 250's up. Well, that tells you that people think the profits of those companies are going to go up. So that tells you that it's not the recession that people are worried about, that it's actually rate expectations. So I enjoy doing this, and if I can try and spark some interest in other people by looking at these stories and looking out there and trying to work out and piece the bits together and then suddenly go, yeah, there was a story, that was it. I think that's a little bit of magic that makes people then start getting into investing.